Despite as much monetary easing as the big central banks are throwing at the markets at the moment, the extreme volatility continues. Why? What is it that markets want, or is it just a simple case of a cure for coronavirus? If we know it's a cure, why are central banks spending all that they have on easing? Simon French is chief economist at Panmure Gordon. He joins us now. Simon, good to talk to you. Let's distill that down to that simple question and ask, what is it that the markets do want?
I think the markets are looking for two things right now. First of all, is some guarantee from governments that solvent businesses, businesses that normally have good cash flow, are profitable, are efficient, are going to be able to see through what is expected to be a temporary bit of disruption without that cash flow impeding their activities and pushing them to the wall. So that's the first thing, confidence that governments can stand in and use their balance sheet to support good companies. And the second thing is whether the measures that have been taken to quarantine, and this is a more a health question, whether those measures are going to be sufficient to stop this becoming a recurring event, something that will disrupt economic activity over the longer term, and therefore you've got to wholly reprice risk.
We've also heard today the IMF says it'll make available its $1 trillion loan capacity. Is this more important than lower rates? Does this go some way to help steer the markets into a slightly better frame of mind? What can the IMF really do with this capacity?
The IMF's capacity is more about those countries that are locked out of the traditional capital markets where liquidity tends to be fairly readily available. And the IMF will be looking to avoid global contagion from amongst those economies that are kind of struggling in an environment where what we've seen in recent days, funding has gone back to dollar markets, euro markets, yen markets, and emerging markets really at the forefront. So that's where there'll be some confidence the IMF can use its balance sheet to support underlying global growth.
What are governments discussing, do you think, behind closed doors? Is there something that perhaps maybe the G7 or G10 or even G20 could be going for, which might be the big global booster that perhaps maybe we're waiting for?
We're waiting for fiscal policy, coordinated fiscal policy on behalf of the major economies. So the G20 would probably be the forum. What you're looking for is interventions from the public sector balance sheets across these countries to reduce the burden over the next few months on employers and companies to try and preserve cash flow. You're looking for tax cuts on payroll, you're looking for retained value-added tax VAT receipts, all designed to get through those difficult months to allow the most efficient companies to come out the other side. If the G20 can lead that action, I think equity markets, currently very, very fractious, will be somewhat more reassured.
What about debt? We've been hearing a lot about the build-up of corporate debt, governmental debt, personal debt, of course. And in the oil markets of late, in the last couple of weeks, we've been hearing a lot about the amount of debt in the system for these oil businesses. Is there a case building for some sort of debt forgiveness coordinated across all developed markets? Is that something that could work? Because you go into this period where, as a consumer, we're stopping spending. These companies still have their costs, and debt doesn't go away, as we know. Ultimately, it could well end up with companies failing because of the debt pile that they've got.
Absolutely. But what you want to do in terms of understanding where debt forgiveness should be provided and where it isn't, is what is the long-term incentives? Are these strategically important businesses that you need to preserve, and through no fault of their own, they have faced an event like COVID-19, which nobody saw coming, and therefore the state balance sheets to support them being going concerns into the future? Or are you going to say that some companies were just too heavily geared to start with, have tapped into debt markets too much over the last decade, and actually this is an event where I'm afraid the chickens are coming home to roost? That will be a delicate balancing act for governments to perform, but a balancing act that they must perform if they're to preserve value for taxpayers, because ultimately this is not a costless intervention.
One final question. Where are we going to be in 3 or 4, 6 months' time? What's the situation going to be? What are the markets going to look like when we get through this?
Well, I think trying to look forward 6 months, you do have some concerns that the virus cycle will have a secondary peak. And I think the medium-term outlook is to whether the various strategies of trying to contain the spread are short-term effective, as we've seen in Wuhan and some parts of Asia. Are they effective in the short term, but they come back later in the year when the weather gets worse? I think if trying to look forward into capital markets, if that secondary spike doesn't take place, then capital markets will recover relatively quickly, as will economic activity. But if we're expecting multiple cycles, then I suspect valuations will remain depressed.
OK, look, Simon, it's a pleasure to talk to you. Thanks indeed there for joining us. Simon French, Chief Economist at Panmure Gordon.